Hi everyone, welcome to LAIMAB. Today I want to share with you a basic and important topic of IFRS Conceptual Framework. Hopefully this will help you a lot. Let's start it. Conceptual Framework for Financial Reporting established for several purposes. There are to assist the board to develop IFRS standards, to assist preparers of financial reports when no standards applies, to assist all parties to understand and interpret standards. There are some status also. These are provides concepts and guidance that developing standards. It's not a standard. It does not override any standards. If any conflict will arise, then obviously we will have to follow the standards. In its history, in 1989, the framework for the preparation and presentation of financial statements was issued by the International Accounting Standards Committee. Later, International Accounting Standards Board accepted this. In September 2010, International Accounting Standards Board made amendments to it, and the new framework was issued with a new name, the Conceptual Framework for Financial Reporting. Then in March 2018, the final version was issued with everything finalized. There were 8 chapters in this new framework in total, and there's the list. Let's take a closer view at each chapter. The first one is about the objectives of general purpose financial reporting. The objective of general purpose financial reporting is to provide financial information about the reporting entity that is useful to existing and potential investors, lenders, and other creditors in making decisions relating to providing resources to the entity. For example, about trading with equity and debt instruments, providing loans, and so on. The entity shall present the information about its economic resources and claims, which is called financial position. Then changes in economic resources and claims resulting from entity's financial performance. The second one is the qualitative characters of the financial information. There are 2 types of characteristics, fundamental and enhancing. The first fundamental characteristic is relevance. So, information is relevant if it is capable of making a difference to the decisions made by users. Financial information is capable of making a difference in decisions if it has predictive value or confirmatory value. And the second fundamental characteristic is faithful representation. Information must faithfully represent the substance of what it purports to represent. A faithful representation is, to the maximum extent possible, complete, neutral, and free from error. A faithful representation is affected by level of measurement uncertainty. And financial information shall have both fundamental characteristics. In enhancing characteristics, first one is comparability. Information should be comparable between different entities and time periods. Then verifiability. Independent and knowledgeable observers are able to verify the information. Then timeliness. Information is available in time to influence the decisions of users. And last one, understandability. Information should be understandable of different entities. These 4 qualitative characters enhance the usefulness of information. Chapter 3 is about the financial statements and reporting entity. First, we are focusing on the financial statements. Financial statements are prepared from the perspective of an entity as a whole, rather than from the perspective of any particular group of investors, lenders, or other creditors. So, in the statement of financial position, the relevant information is provided by recognizing assets, liabilities, and equity. And in the statement of financial performance by recognizing income and expenses. And in other statements where we show the information about cash flows, notes, and other relevant information. Financial statements are prepared on the assumption that a reporting entity is a going concern and will continue the operation for the foreseeable future. Now we are focusing on the concept of reporting entity. An entity that is required or choice to prepare financial statements, and this entity can be single entity, more than one entity, for example parent and its subsidiary, or even a portion of an entity, for example some division of one company like branch. So there are few types of financial statements. Consolidated financial statements. The parent and its subsidiaries provide information about assets, liabilities, equity, income, and expenses as a single reporting entity. Then combined financial statements provide information about assets, liabilities, equity, income, and expenses of two or more entities that are not all linked by a parent and subsidiary relationship. And unconsolidated financial statement, where parent alone provides the financial information. Now, chapter 4 talks about the element of financial statements, and the elements of the financial positions are assets, liabilities, and equity. An asset is a present economic resources controlled by the entity as a result of past events. A liability is a present obligation of the entity to transfer an economic resources as a result of past events. And equity is the residual interest in the assets of the entity after deducting all its liabilities. And other elements relate to financial performance are income and expenses. Income is increases in assets and decreases in liabilities that result in increases in equity other than those relating to the contributions from holders of equity claims. Expenses are decreases in assets or increases in liabilities that result in decreases in equity other than those relating to distributions to holders of equities claim. Chapter 5 is about recognition and derecognition. Recognition means inclusion of an element of financial statements in the statement of financial position or the statement of financial performance that meets the definition of an asset, a liability, equity, income, or expenses. Recognition is appropriate if it results in both relevant information about assets, liabilities, equities, income, and expenses, and a faithful representation of those items, because the aim to provide information that is useful to investor, lenders, or other creditors. Derecognition is the removal of all or part of recognized assets or liabilities from entities' statements of financial position. So here recognition is talking about the inclusion of elements of financial statements in the statement of financial position and in the statement of financial performance. But derecognition is talking about the removal from the entities' statements of financial position. Now chapter 6 is about the measurement. Measurement means in what amounts to recognize. Here discusses about two basic measurement bases. One is historical cost, that's basically the transaction price at the time of recognition of the element, and the second one is current value, which provides information updated to reflect conditions at the measurement date. Current value measurement bases include fair value, value in use for assets, fulfillment value for liabilities, and current cost. Many factors need to consider when selecting the appropriate measurement basis. The most important one is the relevant financial information and provides faithful representation of the financial performance and position. Now, chapter 7 is the presentation and disclosure. Presentation and disclosure are communication tools. With the purpose of make the communication effective, it needs concentrating on objectives and principles, not the rules. Then classifying the information so that similar items are grouped and dissimilar ones separated. And finally, aggregation information, but need to prevent too many unnecessary details and also the excessive aggregation. Chapter 8 is about concepts of capital and capital maintenance. Here, framework explains two concepts of capital. First one, physical capital, which is regarded as the productive capacity of the entity. For example, units of output per day, and here the profit represents the increase in physical productive capacity increases over the period. And the other is financial capital, is synonymous with the net assets or equity. It is defined in terms of nominal monetary units. Profit represents the increase in nominal monetary capital over the period. That was the short summary of the new conceptual framework as issued in 2018. Please give this video a thumbs up. That always helps reaffirm that the content that I am creating is valuable. And if you want to see further content like this, please hit that subscribe button, and that way you will get a notification anytime new content like this comes out. And lastly, if anything else you want me to show you how to do, leave a comment down below. I will add it to my list of videos to create. That's all I have for you today. I hope to see you next time. Bye.